Hello, I'm Maria. I'm the author of Apartment Prescription, How Made from 0 to 50 Apartment Units in 7 Years, and I know you can too. It's available in Amazon, and I'd like to go over a property with you. It's a 22-unit apartment located in Las Vegas. So here are the numbers. It's a 22-unit, which is located in Las Vegas. The studio, and there are 10 units of this, and the rents currently are $925. The one bedroom is currently rented at $1,125. There's 8 units of that. The 2 bedroom is at $1,250, and there's 4 units of that. And it got last sold in 2018 for $1,080,000. It's recently renovated, and the owner is selling it for $3,175,000. Now the cap rate is 5.4%. So that means if you are to purchase the property all cash for $3.175 million, then you're going to get 5.4% on your money that you paid all out cash. The net operating income of this 22-unit apartment is $172,000 per year. Now to move on. So how do we calculate the cap rate? So the formula for cap rate is net operating income, or NOI, divided by the price. So for this particular example, the net operating income is $172,000. The selling price is $3.175 million. Now the cap rate is 5.4%. Now to get the down payment, either you would need to use all of your cash, or you will pull from your power base, which is your family, friends. And to buy a property such as this 22 unit, it's recommended that you have a down payment of about 30%. You can also have a down payment of 20%. It's all up to you. Now, in this particular situation, the down payment is 30%. So if the purchase price is $3.175 million, that down payment is $950,000. How did we get that? $3.175 million times 30% equals $950,000. Now, the debt is $2.25 million. So how did we get that? It's $3.175 million of the selling price minus our down payment of $950,000. So our outstanding debt is $2.22,225,000. Now, the rates out currently at today's market, which is August 2021, there are rates that you can borrow for 3.25% to 3.75%. During this particular case, a lender can lend 3.25% for 5 years, and that's good. 3.25% interest-only payment. So for debt payment, the formula is debt times the rate factor of 0.057. So the rate factor is not only the interest, but they also consider the principal. Now this varies, the principal and interest, but we'd like to use the rate factor, which is a constant of 0.057. So in this case, the debt payment is $2.25 million, which is our debt, times the rate factor of 0.0572. And that would give us a debt payment we have to pay of $127,270. Again, the debt payment is $127,270 that we have to pay every year. So the net operating income, or NOI, using old taxes is $172,000. Now this is only a rough estimate, so to get the new taxes. So in order for you to know what the new taxes are, you'd have to call your assessment office to know what the new taxes will be when you buy the property. So the net operating income using new taxes, like I said, this is only an approximate, is $150,000. How did we get to that number? $172,000 minus $25,000 will give us a new NOI, or net operating income, of $150,000. So the cash flow, or CF in this case, is NOI, or net operating income, minus the debt payment. So our cash flow is NOI, or net operating income, of $150,000 minus the debt payment of $127,270. This will give us a cash flow of $22,730. That's $22,730. Now our ROI, or return of investment, the formula is cash flow divided by the down payment. In this particular situation, our ROI is cash flow, which is $22,730, divided by $950,000, which is our down payment. And that would give us an ROI of 0.023. Now, why did we multiply it by 100? To get to a percent. So our ROI is 0.023 times 100 equals 2.3%. ROI of 2.3%. But that's really very small. Now, if you consider, though, bank, if you put your money in the bank, your interest is what? 0.05, 0.01. So that's why it's good to invest in cash flowing properties. Now, if we increase the rent by $250,000, and this is 22 units, now this is where the magic comes in. Because if we increase the rent by $250 per unit, so 250 times 22 units times 12 months will give us $66,000 of new income. Let's say we do not get all the $66,000 new income. Let's say we get 50% only of new income. So that would be $33,000. So it's $66,000 divided by 2, or 50%, is $33,000 of new income. So the cash flow of the $22,730 plus the new income of $33,000 will give us new NOI of $55,730. $55,730. Now, to get the new return of investment, ROI again is cash flow divided by the down payment. In this case, the new cash flow is $55,730 divided by $950,000, which is our down payment. That would give us 0.058 times 100 to get to percentage, and that is 5.8%. 5.8% of our return of investment. So to continue, the net operating income with new taxes is $150,000 plus the new income with a rent increase of $250 per unit, which is $33,000. So that would give us $183,000 of new income. 150 plus 33 equals $183,000 of new net operating income. So with a rent increase of $250 per month per unit, that would increase our value by $611,000. How did we get the $611,000? That's the magic. So this is how we did it. $33,000, which is divided by 5.4% cap rate, will give us $611,000. Now, do you remember how we get the $33,000? This is the new income. When we increase the rent by $250, that was $66,000. Now we said we were very conservative. What if we only get 50%? So that's how we come up with $33,000. So $33,000 divided by 5.4% cap rate will give us a new value of $611,000. So the down payment is $950,000. So $611,000 is 2/3 of your down payment back. That's almost 75% of your money back. So those are the numbers for today's 22-unit property located in Las Vegas. I hope you learned something. Please don't forget to subscribe to my channel, and you can also get a copy of my book, Apartment Prescription, in Amazon. Take care, God bless, and happy investing.